Hello, this is Stephanie Anderson, Certified Wealth Strategist here at Pulse Financial Services, and we're happy to have you here with us this afternoon. Thank you for joining. I am going to go ahead and update you on our views on the economic and market outlook using slides from our first quarter 2026 Guide to the Markets put out by JPMorgan. We're going to go through 10 points in 10 slides in 10 minutes, so brace yourselves. First, the economy should speed up and then slow down in 2026, averaging 2% growth for the year. The collective impact of tariffs, the federal government shutdown, and declining net immigration slowed the economy in late 2025. However, demand was supported by strong spending on AI infrastructure and solid consumer spending by upper income households following a third year of huge stock market gains. This support should continue into 2026. While we believe fourth quarter GDP growth was weak, we expect growth to bounce to roughly a 3% annual pace in the first half of 2026 due to surging income tax refunds before fading later in the year in the overall absence of further fiscal stimulus. Overall, we expect economic growth to come in at close to 2% for 2026, up slightly from 2025. Second, lower immigration should limit the rise in unemployment despite slow job gains. Slower GDP growth, diminished labor supply, and significant federal government job cuts resulted in much slower employment growth over the course of 2025, with average monthly payroll gains falling to just 17,000 between May and November. We do expect job growth to accelerate in early 2026 to between 50,000 and 100,000 jobs per month as consumer spending surges, and then fade to below 50,000 per month as the economy slows later in the year. However, the impact of this slow job growth on the unemployment rate should be suppressed by lower immigration. Illegal immigration has fallen almost to zero, and deportations have increased. Data through May of 2025 also suggested a decline in new immigrant visas issued. Data on both deportations and legal immigration are very spotty, but overall, we believe that net immigration has fallen to a pace of less than 250,000 per year, down from an average of over 1 million per year in the 2 decades before the pandemic. This implies a flat or declining working age population holding the unemployment rate at roughly 4.5% in early 2026 and allowing it to edge down toward 4% later in the year. Wage growth has softened, but should stabilize as a lack of qualified workers counteracts recession worries in wage negotiations. Third, inflation should rise in early 2026 due to income tax refunds and a delayed pass-through of tariffs, but then fall back toward 2% later in the year. Current inflation trends are particularly hard to assess since the government shutdown forced the cancellation of the October CPI survey and late data collection for the November numbers. Overall, we believe CPI inflation rose to 3% year over year in December, from a reported 2.7% in November. Inflation could then rise further in early 2026 as strong income tax refunds allow retailers to pass on tariff costs. Still, slow wage growth, low gasoline prices, and weak housing demand should keep a lid on inflation, with year-over-year CPI gains only rising to 3.5% by June before falling back to close to 2% by the end of the year. Summing it up, our forecast for 2026 is 2024, the same as the forecast we outlined 2 years ago. 2% economic growth, no recessions, inflation falling to 2% by the end of the year, and the unemployment rate falling back to 4%. Fourth, profit growth should remain solid in 2026 as companies benefit from strong productivity gains, subdued wage increases, and recent tax cuts. Despite less than 5% growth in nominal GDP last year, the pro forma earnings of S&P 500 companies rose by over 10% for a second consecutive year, led by technology stocks, but also including strong gains from financials and healthcare companies. This strong earnings growth was boosted by tax provisions in the One Big Beautiful Bill Act. However, it also reflected an impact of a falling dollar in boosting the dollar value of foreign revenues, as well as relatively restrained wage growth and solid productivity gains. We do expect all of these trends to persist in 2026, which should lead to another year of close to double-digit earnings gains. However, earnings growth is, as ever, very cyclically sensitive, so a fall into recession would undoubtedly lead to a much less positive outcome. Investors should also be aware of the somewhat circular nature of earnings growth within the tech sector, so that if something goes wrong with the AI theme, corporate earnings could take a more serious hit. Fifth, the Fed could cut twice in 2026 and possibly 3 times if growth and inflation both fade. The Federal Reserve cut the federal funds rate by 0.75% in late 2025, following a 1% total reduction in late 2024. This has brought the rate down to a range of 3.5 to 3.75%. Markets are pricing in a better than 50% shot of another rate cut in the first quarter and a 100% shot of at least one rate cut in the first half of 2026. We believe this is likely, assuming that the economy does not see a further burst of fiscal stimulus. And the Fed may cut again in September, bringing the funds rate down to a range of 3 to 3.25%, essentially at the Fed's 3% estimate of the long-run neutral rate. However, if the economy weakens again in late 2026, particularly if the result of midterm elections appears to preclude the possibility of further fiscal stimulus, the Fed may move to an accommodative stance in late 2026. Since this will not actually stimulate the economy, by 2027, the Fed could find itself cutting short-term rates further on the slippery slope toward the zero lower bound once again. Sixth, the dollar could fall further, reflecting slower U.S. growth and continued Fed easing. The dollar fell sharply in 2025. This may in part reflect its high valuation going into the year and America's chronic trade deficit. However, it could also be the result of questions among both U.S. and international investors about their concentration in U.S. assets and the policies of the U.S. administration. A key driver of the dollar in the long run has been the higher interest rates offered on U.S. debt compared to other developed market economies. As the Federal Reserve cuts more aggressively than other central banks in 2026, we believe this narrowing in interest rate spreads, combined with a still high trade deficit, should lead to a further dollar decline. Seventh, bond yields look close to fair value, arguing for a neutral allocation. A resumption of Fed easing and signs of a weaker labor market have allowed long-term interest rates to drift down in recent months, even as inflation has gradually increased. From here, however, we expect long-term rates to remain range-bound as the effects of monetary ease are counteracted by increased Treasury issuance, a temporary surge in economic growth, and delayed tariff-related inflation. For investors, there is not a strong argument for making a bet either on duration or credit in bonds. Even if the economy weakens further, any rally in bonds should be limited by rising federal borrowing and stubborn inflation. Moreover, at least in the short run, we expect the economy to avoid recession, partially justifying today's tight credit spreads. However, we do think that roughly normal bond allocations make sense in this environment. Historically, today's close to 4.3% yield on the Bloomberg Bond Index has been associated with close to 4.3% annual returns over a 5-year period. Provided inflation fades later in 2026, these yields and potential returns seem reasonable. Eighth, mega cap U.S. equities still look expensive relative to the rest of the market. One glaring anomaly entering 2025 was the huge outperformance of the largest companies in the S&P 500, both in terms of earnings and equity market gains. Much of this reflects the dominant market position of U.S. tech firms and a surge of interest in and investment spending on artificial intelligence. That being said, in recent years, the stock market outperformance of these companies has generally outpaced their performance in earnings, leaving their valuations at high levels relative to the rest of the market. This anomaly persists today, with the top 10 companies of the S&P 500 representing roughly 40% of the market value of the entire index. For long-term investors, it may make sense to increase allocations to other areas of financial markets in case economic, geopolitical, or idiosyncratic forces turns a mega cap U.S. equity boom into a bust. Ninth, international equities still look cheap relative to the U.S. market. In 2025, international stocks sharply outperformed their U.S. counterparts as local currency gains were amplified by the impact of a falling dollar. Given this dramatic outperformance, many investors may be wondering if they have missed the boat in increasing international allocations. We don't believe so for three reasons. First, even after a 2025 rally, non-U.S. stocks still carry much lower valuations than their U.S. counterparts. Second, the dollar remains very overvalued given our trade fundamentals, and we expect it to fall in the years to come. And third, given the outperformance of U.S. stocks over the last decade, most U.S. investors are likely very underweight in international stocks relative to an appropriate long-term asset allocation. And 10th, alternative investments can add total return, income, and diversification to portfolios. The last few years have seen very strong stock market gains. However, that very outperformance could limit future returns. Moreover, the traditional role that bonds play in zagging when stocks zig has been challenged in recent years by higher inflation, which negatively impacts both stocks and bonds. In this environment, many investors are exploring alternative assets such as private equity, private credit, infrastructure, and real estate. These assets are all quite different. Some provide strong long-run returns, some generate strong current income, and some act as a good diversifier to publicly traded stocks and bonds. Many of them are quite illiquid, and so it should be thought of as only a long-term investment. Moreover, the performance of different assets within the alternative space has varied considerably depending on the manager. Still, adding alternative to a traditional stock bond portfolio may make sense for many investors, and we expect this area of financial markets to continue to grow in the years ahead. It should be noted, finally, that while alternatives can play a defensive role in portfolios, they can also be used for offense, allowing investors, for example, to participate in the AI theme through smaller private firms building new AI applications or generating the electricity necessary to develop them. However, more broadly, alternatives and international equities can both play an important role in rebalancing portfolios. This is important since after 3 great years for the U.S. equity markets, investor portfolios are not just significantly larger, but also more risky and more concentrated than most investors intended. Consequently, the most important financial resolution of the new year should be to rebalance, particularly if this can be done in a tax-efficient manner. So there you have it, folks. Here are our disclosures. And Andy and I are obviously available to chat through this content with. If you want more personalized information, if you would like to schedule a meeting with us, here's our contact information. We're definitely available and happy to help with understanding any of the current market or economic trends. Thank you so much for your time. We wish you a wonderful rest of the day and week. Take care. Bye-bye.